Well, hi everyone. Welcome to another video on the income tax series. My name is Gaurav Lohia and I'm a chartered accountant. In the last video, we discussed about what is tax, why do we pay taxes, what are the different types of taxes, and who can levy taxes. In today's class, we will first understand what is the structure of the income tax law in India, right? What is the structure of the income tax law in India? So income tax law in India is made out of five components. It's made up of five components, right? What are those components? So the first one is Income Tax Act 1961. The second is the Annual Finance Act, more popularly known as the budget. So the third one is the income tax rules. The third one is the Income Tax Rules 1962. The fourth one, the fourth one is the circulars and the notifications issued by the CBDT. The fifth one, the fifth and final one is the judicial pronouncements, more commonly known as case laws, right? So let us look at these five components one by one, right? The first one, Income Tax Act 1961. Now, this is the main law of the income tax, which governs the levy, computation, and collection of income taxes in India. It has got sections from 1 to 298, right? The second is the Annual Finance Act, that is the budget. This act is updated annually, that is every year there is a new act which comes in. Say for example, Finance Act 2025, Finance Act 2024, and in future Finance Act 2026, 27, 2027, 28, and so on, right? Finance Act, what it does is it adds amendments to the Income Tax Act, right? Say, more commonly, you might be aware that the income tax rates are decided or defined under the Finance Act. TDS rates are many times uh, defined or made changes to under the Finance Act, right? The third is the Income Tax Rule 1962. Income Tax Rules 1962. So the rules, income tax rules are, these are the rules which are formed by CBDT, right? And the rules actually gives the procedures, the forms, or the methods uh, to to the income tax law, right? So say if you have to file the income tax return, the form is given by income tax rules, right? The fourth one is circulars and notifications. Now these are two different things. One is the circular, one is the notification. The circulars are uh, a document in terms of clarifactory in nature. So anything, the CBDT issues the circulars on matters where clarification is required, right? Clarifying certain aspects of law, CBDT will issue the circular. Now, the circulars are binding on the department, but not on the SSE, right? What does binding mean is the department has to definitely follow the circular. The SSE has an option to follow the circular or not. Notification, on the other hand, notification is a document again published by the or issued by the CBDT to give effect to any changes, or any amendments in the law, right? It is binding on everyone. So the notification where, uh, though the circular is binding only on the department, the notifications are binding on everyone, right? SSE cannot say that it is not binding on me, or I will not follow the notification. They have to follow the notification. The final thing is judicial pronouncements or judicial decisions, or more commonly called as the case laws. These are issues which are already interpretation matters decided by the court, right? An easy way to understand it, see, the court interprets the law and sets a standard on how to follow a particular provision in the law. Here, the legal hierarchy has to be followed. That is tribunal, then the High Court, then the Supreme Court. And once a Supreme Court decides on any matter of law, that becomes the law of the land. And everybody has to follow. Everybody is bound by the decision of the court, right? So these are the 5 main components, or this is the structure of the income tax law in India, right? Moving on, next the question is CBDT. What is CBDT, right? What is CBDT? Now, CBDT, to understand it in simple terms, is the authority or the governing body of direct taxes in India. Any kind of direct taxes, though more predominantly it is the income tax in India. Any kind of direct taxes levied by the central government would be governed by CBDT. The full form of CBDT is so CBDT stands for Central Board of Direct Taxes. It is the ultimate authority who administers the direct taxes in India. They are the authority who have framed the rules for income tax. They are the authority who will issue all the circulars and the notifications. They are the authority who governs the collection of income tax. They are, in terms, you can define CBDT as the controller of income tax who works under the Ministry of Finance in India, right? Ministry of Finance in India. So moving on to the next thing, next question, that is, why do we need the Finance Act? So the second component of the structure we discussed was the Annual Finance Act, or the budget, more famously known as. And I said that it is updated every year, right? But why do we need the Finance Act to update income taxes? We have our Income Tax Act. Why can't we just define everything in the Income Tax Act? And why do we need to make changes every year? See, there are certain things which are not permanent in nature, right? For example, rates. There are certain things which are not permanent in nature. One is, let's say, your rates of income taxes. The other thing is your rates of TDS or TCS. These are some things which regularly keeps on changing, ideally once a year, or once in 2 years or 3 years, right? So now it is very difficult for the government to change a particular act, right? So what does government do is they have just in the income tax act they say that okay, the rates would be defined in the annual finance act, and then the annual finance act defines the rates of income taxes, defines the rates of TDS or TCS. It also brings in certain more changes, like bringing in the new scheme of you might have heard there's an old regime and a new regime. So bringing a new regime that also was brought in from the Finance Act, right? Any other amendments also which has to be made into the Income Tax Act, that can also be made through the Finance Act, right? Next. So next thing is a very, very important uh, concept in the Income Tax Act. Very important concept, right? One is called the previous year and the other is called assessment year. So yeah, these two things are very important in the Income Tax Act, and you will constantly keep on hearing about previous year and assessment year. And you have to understand these two things to solve any given problem in income tax. Any question in income tax, you have to understand what does previous year mean, what does assessment year mean, right? So what do they mean? Starting with the previous year, right? Previous year is the year in which income is earned. The previous year is the year in which income is earned. Say, for example, let's say you are working in a company and you earn salary, right? So for the month of April 2025, let's say, right? So to give an example, you earn salary and any salary you would have earned in the month of April 25, the previous year for that would be financial year 2025 to 2026. So for previous year is a period of 12 months starting from April to March, uh, to March of the next year, right? And any income which is earned during this period, any income which is earned during that particular period of April to March, that year would be called as previous year, right? So this can only be understood with the help of an example, unfortunately. So any income, let's say you earn from April 25 to March 26, that would fall under previous year 2025-26. Any income which you would have earned in the financial year 24 to 25, previous year would be 24-25, right? So any income earned during the financial year from April 2024 to March 2025, the previous year would be 2024 to 2025, right? So to understand it simply, it is the year in which the income is earned. The financial year in which the income is earned is called the previous year. The next thing is the assessment year. So Assessment year is the year in which the income is taxed. Assessment year is the year in which the income is taxed. So in the previous question where you earned salary in April 25, your assessment year would be 26-27. So assessment year usually is the year immediately subsequent to the previous year, as you can see in the examples. Okay, so let's say any income which you have earned in 25 to 26, previous year 25-26, you offer it to income in the next year, you offer it to tax in the next year, so your assessment year becomes the next year, that is 26-27. Income which you would have earned in the previous year 24-25, the assessment year for that would be 25-26, right? So as simple as that. Any year, the income earned in a particular year becomes the previous year. The next year of that, the immediately subsequent year of that becomes the assessment year, right? But there are certain exceptions to this, right? There are certain exceptions to this. What are the exceptions? What do I mean by exceptions? First of all, the exceptions means the general rule is any income which is earned in the previous year is offered to tax in the assessment year. However, there are certain cases wherein the income will be taxed in the previous year itself, right? There are certain instances wherein the income will be taxed in the previous year itself. What are those instances? Some of the instances are, let's say you are a non-resident person having a shipping business, right? If you are a non-resident having a shipping business, or you are a person who is permanently living in India, not living in India, leaving India, that is, you are migrating out of India permanently, or if not permanently, at least for a elongated period, right? Then you could also be an association of person or a body of individuals or a particular trust which has been constituted only for a particular purpose, and that purpose has been completed within the previous year. So the and you go for dissolution, then you have to charge or you have to offer the income for tax within the previous year. Then uh, under certain special circumstances, the government also, or the tax department can also ask you to, offer the income within the previous year. Those kind of cases could be where you are likely to transfer assets to avoid any taxes. Do not worry. In future classes, we will understand these kind of things in detail, right? That what does it mean of transferring asset to avoid taxes, or those kind of things, right? Another example of where the income can be charged to tax within the previous year is, let's say the business gets discontinued, right? Or you go for dissolution or liquidation, those kind of cases, right? So hope the concept of previous year and assessment year is clear. Lastly, in the video, I just want to take you through the scheme of taxation, right? So there are 15 steps given by ICAI, and beautiful steps they are, to compute income tax of any person, right? So these 15 steps are the backbone of the entire income tax law for our syllabus, right? If you remember these 15 steps and just follow them, any problem can be solved easily. So I hope the 15 steps are visible on my left here. So the step 1 is determination of residential status. First, for any person, the residential status has to be determined. Then you classify all the incomes under different heads. The second step is you classify all the incomes under different heads. There are 5 heads. We will discuss all these steps in details in future classes. For now, just note this down and remember these steps, right? Try to remember these steps, or else we'll do so many problems that you'll automatically remember these steps. Even at night, 2 o'clock, if somebody wakes you up, you would be able to tell these easily, right? That is the level of preparation I'm expecting out of everyone. So the second step is classification of all the incomes under different heads. The third is computation of income of each head. So under each head, you compute the income. The fourth is clubbing of income of spouse or minor. If there is any income of the spouse or a minor child or anyone else which needs to be clubbed, you have to club. Then you set off or carry forward, or if there are any carry forward losses, you set that off. So when we say set off, it is interhead set off, any carry forward of losses or any set off of losses from the previous years. The sixth step is computation of gross total income. So the sixth step is gross total income. Seventh step is deductions from the gross total income. Mainly it is from chapter 6a, deductions, but we will look into each and every steps in future, as I have already told. The eighth step is computation of the total income. Seventh is application of rates of taxes on the total income. This step 9, sorry, got distracted at that. Step 9 is application of the rates of income taxes onto the total income. Step 10 is charging any surcharge or any rebate under section 87A. Once the surcharge is charged, then we move on to step 11, that is charging the HEC, health and education cess. Then step 12 is calculating the alternate minimum tax, if any. Step 13 is comparing the tax under 115 BAC versus normal regime, more commonly known as new regime versus the old regime, right? New regime versus old regime. Step 14 is adjusting any advance tax or TDS or TCS, which is already paid, right? And the fifth step is tax payable or refundable, that is calculating the ultimate tax payable or refundable, right? So we will look into each and every step in detail in the future videos. For now, this is it for this video. Let us quickly recap what we have studied today. That is, first, we understood the structure of Income Tax Act. There are 5 components to the income tax law in India: Income Tax Act 1961, Annual Finance Act, Income Tax Rules 1962, circulars and notifications, case laws or judicial pronouncements. Next, we understood what is CBDT, Central Board of Direct Taxes, the body governing the direct taxes in India. Then why do we need the Finance Act? Mainly to update the rates of income tax or TDS or TCS, or give effect to, or bring in any new amendments. Then we understood about the concepts of previous year and assessment year. Previous year is the year in which the income is earned. Assessment year is the year in which the income is offered to tax. We also looked at the exceptions which are there for assessment year. And finally, the scheme of taxation, that is the 15 steps, 15 very important steps of income, computing the income tax, right? So this is it for the video. Thank you. Do tune in for the next video. Do press like if you did like, or comment if you didn't like it, what you didn't like it, and what improvements would you like me to make. Thank you.